Hello class. In this video lecture, we're going to take a look at Chapter 3, Working with Financial Statements. This chapter introduces a variety of topics, including standardized financial statements, ratio analysis, the DuPont identity, and internal and sustainable growth rates. This chapter also deals with things to take into consideration when we're using financial statement information. After learning this chapter, you will be able to build standardized financial statements, compute and interpret financial ratios, to assess the determinants of a firm's profitability and growth rate. Also, you will be able to identify and explain the reasons for financial statement analysis and also how to choose benchmarks. So, what is a standardized financial statement? It is also called a common size financial statement. So a common size balance sheet would be a financial statement or a balance sheet that is presenting all accounts in percentage of total assets. Also, a common size income statement would be presenting all accounts in percentages of sales or revenues. These standardized statements or common size statements would be useful for comparison purposes, especially comparing financial information year to year, and also especially if they're within the same industry. It would be easier to understand the standardized financial statements with an actual example. So the financial statements that you're looking at are the balance sheets of Prufrock Corporation for 2018 and 2019. So these are just regular balance sheets. But the standardized balance sheets would present all the numbers in percentage of total assets. So for example, cash here, instead of presenting the dollar amount of cash, it's presented as the ratio between cash and total assets. So 2.5% would be 2.5% out of the total assets. Same thing for all other accounts here. And also the same thing for the income statement. So these are the regular income statement items. But then if you wanted to present them as standardized income statement, it would look like this. So the first line would be giving you the total amount of sales, which is 100%. And then as you go down, you're presenting all other items as a ratio between the item and the sales. So 56.9 would represent 56.9% out of the total sales amount, 11.7% out of the total sales amount, and so on. So by doing so, as you could see in the balance sheet, it is much easier for you to compare between 2018 and 2019. Also, if there was another balance sheet of a different company within the same industry, even if their company sizes were completely different, it will be much easier for you to compare between the two different companies.
The next topic is ratio analysis. By ratio analysis, we're trying to extract certain information from the financial statements to compute certain important ratios here. It will allow us to diagnose and analyze a firm's financial status, and also it will allow a better comparison opportunity both through time and between companies. For such reasons, ratio analysis methodology is used both internally and externally. So before we proceed to more details about ratio analysis, it is very important that we understand that we need to ask the following questions for each and every ratio that we're going to learn. The first question is, how is it computed? So basically, we will have to understand and remember the formulas for each ratio. B, what is it intended to measure? So what is the content of the ratio and why is it interesting? And more importantly, I would say the important question here is to whom is it interesting? The last question is, what might a high or low value tell us? So basically, is it better to have a higher number here or a lower number here? Okay, that's what you will need to understand and also remember. So the categories of ratios, the groups of ratios that we're going to learn would be the following 5 categories. So first, liquidity or short-term solvency ratios. Second, financial leverage or long-term solvency ratios. Third, asset management or turnover ratios. Four, profitability ratio. And the last one is market value ratios. So group one, liquidity or short-term solvency ratios. How is it computed? How are they computed? So there are three ratios under the category of liquidity. And the first thing you see is current ratio. Current ratio is computed as the ratio between current assets and current liabilities. And so if we try to understand it in terms of the balance sheet, we're taking the current asset from the assets and current liabilities from the liability section and trying to create the ratio between the two. And doesn't that remind you of a term that we recently learned in chapter 2? So it is very closely related to net working capital. So when we were computing net working capital, it was current asset minus current liability. So we were taking the difference between the two. Now we are taking the ratio between the two, and that will be the current ratio. So the current ratio and net working capital, it will be closely related. And the remaining two of the liquidity ratios would be very much like current ratio as well. So the only difference between current ratio and quick ratio is that for the quick ratio, you will have to take away inventory from your numerator. The reason is because inventory is the least liquid asset. So by just, removing inventory from your numerator, you are taking just more liquid assets among the current asset items. And cash ratio, among all the current asset items, we are just, disregarding all others except for cash. So the cash here, how much cash we have, that will be our numerator. And then we're taking that to be divided by current liabilities. So that's how we compute current ratio, quick ratio, cash ratio. So the rule is very simple. We are taking different amounts for our numerator, but it will all come from current assets. Whether we take the full amount of current assets or maybe just a couple of items from the current assets, that would be just creating the differences among the three. But our denominator will always be the current liabilities. And by doing so, what are we trying to measure here? So as we saw before, once again, current asset items, whether we take the full amount or just like everything except for inventory or maybe even just cash, it will be from the current assets, right? And then you divide it by current liabilities. So by doing so, what we're trying to compare is how much current assets, how much immediate access we have in terms of assets to be able to cover our short-term liabilities. So a proper way to say that would be a firm's ability to pay its bills over short run. So bills over the short run without undue stress. So how much immediate access of cash, immediate access of current assets we have to be able to pay the short run bills. So our focus would be on current assets or maybe just different items under current assets and current liabilities. So of course, as you can see, this would be interesting information for short-term creditors, okay? So this would be most interesting to short-term creditors and also loan officers at the bank. So what might a high or low value tell us, or is it better to have a higher or lower number? In general, the higher the better. The more current assets you have so that you will be able to pay off your short-term bills, the better situation or the healthier your firm situation is. But is it always better to have a very high number? I would doubt that. The reason is, what that means is you have a tremendous amount of current assets or maybe a tremendous amount of cash sitting there idle on your balance sheet. So that might indicate an inefficient use of cash or inefficient use of current assets that could have been used for other investment opportunities. So an absurdly high number of current ratio or liquidity ratio would indicate an inefficient use of current assets, but in general, in most cases, if the number was just within the reasonable range of high number, I would say that would be more preferred rather than having a very low number for liquidity ratios. Group number 2, long-term solvency ratios. So you see 5 different ratios, 5 different formulas for long-term solvency or leverage ratios, but we can actually group them in 2 different groups as well. So the first group is the first 3, total debt ratio, debt to equity ratio, and also equity multiplier. These 3 would be from the balance sheet, whereas the latter 2, times interest earned or interest coverage ratio and cash coverage ratio, these 2 would be from the income statement. So I will try to split the ratios into 2 groups. And the way to compute it, the rationale for the formulas are different as well. So the first 3, these would be from the right-hand side of the balance sheet and trying to measure the proportion of liabilities in comparison to different sections of the balance sheet. So the total debt ratio, the numerator here is total assets minus total equity, or maybe just total liabilities here. So this is your liability, and then you divide it by the amount of total assets. This is total debt ratio. So here, let's just call this number 1, number 2, and then number 3, right? And then the first one here would be measuring number 2 divided by number 1. The second one, debt to equity ratio, would be liabilities divided by equity. So this would be number 2 divided by number 3. And then finally, equity multiplier, you're using a different numerator this time, which is number 1. And then you'll divide it by equity number 3. The letter 2, on the other hand, are from the income statement. So from your income statement, which would start from sales, and then you will expense out certain operating expenses, including the depreciation. You would arrive at the EBIT. And from your EBIT, of course, the first expense to expense out would be interest expense. So this is the order of interest expense. From this income statement, you are taking EBIT and interest expense. So EBIT would be your numerator, and then you divide it by the interest expense. That would be your interest coverage ratio or times interest earned. And the second one is very similar. Instead of using just the EBIT amount for your numerator, you're adding back depreciation. And use the sum of EBIT and depreciation as your numerator, and you divide the sum by your interest expense, and that will be your cash coverage ratio. So as you can see, these 2 groups are from different financial statements.
Now, the next question is, what are we trying to measure with the long-term solvency ratios? So both groups are trying to address the firm's long-run ability to meet its debt obligation or its financial leverage. So in that sense, both are measuring the same thing. However, the first group, those from the balance sheet, would be trying to measure the proportion of liabilities. So it's just focusing on the amount and the proportion of liabilities, whereas the second group, times interest earned and cash coverage, they are trying to measure a firm's ability to be able to cover its interest obligations. So as you saw before, it's either EBIT or EBIT plus depreciation. So what is trying to capture is its operating income, the income that comes right before interest expense. And then for cash coverage, of course, you will have to add back depreciation because we're trying to capture the cash ability that you have. So depreciation obviously is a non-cash item. So to nullify it, you're adding it back. That's what it's doing. So anyhow, so by doing so, you are trying to see how much more income you would have or how much income you have to be able to cover the amount of interest expense that you have to pay. So the final question is it better to have a lower or higher number in terms of the long-term solvency ratios? It's a bit tricky question. So for the first group, for total debt ratio, debt to equity ratio, and also equity multiplier, it's a bit tricky. In general, from the perspective of an external creditor or external investor, in general, it's generally preferred to have a lower number. So lower leverage means its debt obligation is smaller. So it's probably better for the potential creditors. So you can just remember it that way. However, it becomes a little bit more complex if you are an insider and a financial manager. And we're going to talk about that when we have an opportunity to discuss cost of debt and also maybe with capital structure. But definitely for the second group, like times interest earned and cash coverage, the higher the better. It would indicate that the level of debt is easy for the firm to service. The third group, it's the asset management ratios, or most likely these are called just turnovers. So these ratios are a little bit tricky to understand. So I want you to pay attention here. So first off, let's start with the formulas. As you can see, all these formulas have the name of turnovers. Remember that the name of the turnover comes as your denominator. So for example, inventory turnover, it would have inventory as your denominator. If there were receivables turnover, then receivables would come as your denominator. So the denominator would have that name. So, and every time you see these turnovers, you would see that these accounts are from the balance sheet. So balance sheet items would be your denominator. And the corresponding income statement item would come as your numerator. So it's, in a sense, income statement item divided by balance sheet item. That's how you're computing the asset management ratio. We're going to come back to days sales or days cost after we talk about the meaning and content of each ratio. So it's probably more important to understand what each ratio is trying to measure. These are intended to describe how efficiently or intensively a firm is using its assets to generate sales. So if you are not really familiar with the name turnover, it's probably better to understand it as like a cycle. So it's inventory cycle, receivable cycle, payable cycle, and also asset cycle. So how many cycles or how many times inventory was completely sold off? That would be inventory turnover. And receivables turnover would be how many cycles, how many times your receivables were completely collected. Payables turnover, how many times your payables were paid off, okay? Finally, assets turnover would be so it's a little bit different. So for every dollar of asset, so per dollar asset, how much of sales did you generate? So that's how, so the number of cycles, that's what these turnover ratios are trying to measure. So how actually link the formula that you saw in the earlier slide with the definition here. So the logic would be just universal across all these, especially the first three turnovers. And it's probably better to understand it with a framework of a timeline. So a timeline of a year is given here. And then let's suppose throughout the year, so the first tick mark would indicate January 1st, and then of course the last one will be December 31st. And then throughout the year, you kept on the balance sheet, your balance of inventory, for instance. Let's just think, let's start with the inventory turnover. And on your balance sheet, let's suppose your inventory balance was constant at $10, okay? Balance sheet, throughout the year, its balance was $10. And then for the whole year, your COGS, the total COGS amounted to $100, right? So what that means is throughout the year, you had to purchase inventory, right? And that the total purchase cost amounted to $100. And having a constant fixed amount of $10 balance in inventory, what that indicates is, let's suppose you started the year with $10 in inventory. So in your warehouse, inventory worth $10 were sitting. And then at certain point, the total amount of $10 were completely sold off. Okay, it completely sold off and it went back to zero. And immediately after that, because you had to maintain your inventory at $10, what happened was you had to purchase $10 worth inventory one more time. Okay, so it was sold off, completely sold off. So another cycle began with $10 purchase of inventory. And then that was completely sold off, so it went back to $0. But immediately after that, you would have to inject or inventory will have to fill up your warehouse with $10 worth inventory. Okay, completely sold off, new cycle begins. And then it, of course, will be sold off completely again. And then another new, $10 worth inventory would be filling up your warehouse. So another cycle. So new inventory and then sold off. New inventory sold off, new inventory sold off. So this is one cycle. $10, $10, $10 being just purchased, all right? How many cycles do you think you would have to have so that the total amount of purchase would amount to $100 for the full year? So that means COGS amounting to $100. And then each time you would purchase $10 worth inventory. Okay, so that means you would have 10 times or 10 cycles, okay? So that's probably a very crude way of understanding why, you're trying to divide COGS by inventory, and that would indicate the cycle of inventory or the cycle of inventory sales. And similar logic would apply to receivables turnover and also payables turnover. Total asset turnover would be slightly different in that it's just mere comparison between sales and assets. So per dollar of asset, how much sales you generated. Okay, that's total assets turnover. So once you understand that, these turnovers are indicating the cycles, then it's probably, you're ready to understand what days sales and inventory, days in sales and receivables would mean. So throughout the year, let's suppose you sold off your inventory 10 times. Then on average, how many days did your inventory sit in your warehouse? So how long did it take for your firm to completely sell off your inventory? How many days did it take for your firm to completely collect your receivables on average? That will be days sales and receivables. And days cost and payables would be how many days on average it would take for your firm to pay off your payables. So the content or the mechanism logic is a little bit tricky to understand, but it's a lot easier to understand whether or not it's better to have a higher or lower number, because as the name suggests, it's trying to capture how efficiently you're using your asset, utilizing your assets. So of course, in general, the higher, the more efficient. The fourth group, profitability ratios, would be probably the most widely known ratios of all. Under that category, you would see profit margin, return on assets, ROA, and also return on equity, ROE. These would have net income as numerators, and it will be divided by sales, total assets, or total equity. So it's as the name suggests, it's trying to measure the profitability of the firm, how efficiently the firm is using the assets, and how efficiently the firm would be managing its operations. So in a sense, it's trying to measure the operational efficiency. And obviously, the higher the ratio, the better the firm's financial status, and also the better the firm's operational efficiency. The last group of ratios would be the market value ratios. And to be able to compute the last group, you need two additional pieces of information from the market. And the first is the stock price. So first, you would need stock price. And the second piece would be the number of shares outstanding. For those of you who are not familiar with the number of shares outstanding, this would indicate the number of stock shares that are available to investors in the market right now. So these two, which should be obtainable from the market, are necessary ingredients to compute the market value ratios. And how are they being used? So the formula here, the ratio formula itself would look like this. So stock price, so the price of stock would be used as your numerator. And for the denominator, you would use the value from the financial statements, either from the income statement or balance sheet, as the numerator of the denominator. A lot of times, you would be using earnings or net income from the income statement, or maybe book value of equity from the balance sheet. Whichever you're using, that will be used as your numerator of the denominator. And then for the denominator of the denominator, you would use the number of shares outstanding. So this is like the format of the formula you would be using. And why does it look like this? It will be discussed in the content slide. Anyhow, this is the format that you will find in all of the market value ratios that you see here, such as price to earnings ratio, price to sales ratio, and also market to book ratio. So for price to earnings ratio, so the format itself is the same, and in place of this numerator of the denominator, you will be using earnings or maybe net income. Okay, so if you are using net income in this place, then it will be called price to earnings ratio. Maybe you would want sales for this place, then it will be called price to sales ratio. And also, if you are using equity from the balance sheet in this place, then that will be called market to book ratio. So with this market value ratio, what are we trying to measure? We're trying to measure how investors are willing to pay per dollar of earnings, sales, or equity. So as you saw before in the formula slide, it took price as the numerator, and the denominator was per share some book value amount, like earnings, for example, or sales, or maybe equity. Okay, and then let me just put it as like book value. So price, which is from the market. So you're taking market value as your numerator, and then the denominator would be book value. So we are trying to take a ratio between the market value and book value, try to compare it. So for investors, in the eyes of an investor, $1 of earnings, $1 of sales, $1 of equity, how much is it worth? So for investors, how much are they willing to pay for $1 of earnings, $1 of sales, $1 of equity? That's what all these market value ratios are trying to measure. And another tricky question just comes up, which is how might a high or low value should be interpreted. A lot of times, higher values may indicate growth opportunities, but also it can be linked to overpricing and also maybe just lower risk. So it depends. Okay, it has a lot of different interpretations. So caution it would be needed for interpretation. It's beyond the level of this course. If you're interested in this topic, you might as well proceed to Finance 3320, where we will discuss a lot about this topic. So put that all together, you may want to refer to this slide, which summarizes all the ratios that we have learned so far. So let's try to practice how to calculate ratios based on an actual example. So you're given the balance sheet and income statement of a given firm. And first, let's compute the liquidity ratio. So if you wanted to compute the current ratio, quick ratio, and cash ratio, first you would need the current assets. So total of current assets right here. And then you'll divide that by the total amount of current liabilities. So 708 divided by 548 would give you the current ratio. And if you wanted to proceed to the quick ratio, then it will be current assets right? Current assets, but from there you will have to take away inventory so that you only have the more liquid assets of the current assets. And then you divide it by current liabilities one more time. And for cash ratio, you will need to divide it by the current liabilities. So cash divided by current liabilities would give you the cash ratio. Next, if we want to compute the long-term solvency ratios, you would have to take the total liabilities, but for here, you don't have the total liabilities, so you'll have to just compute it on your own, which is total current liabilities plus long-term debt. So you just add these two amounts to find out the total debt or total liabilities, and then you divide that by total assets. That will give you a total debt ratio. Next, if you wanted to compute the debt to equity ratio, then total liabilities here, the sum of these two numbers, and then you divide it by total equity, 2625, all right? And that will give you, this is a typo, you should have 0.38 here. And then finally, for equity multiplier, that will be total asset divided by total equity. So 3630 divided by 2625 would give you the equity multiplier. Also, for times interest earned and cash ratio, these ratios can be computed with the items from the income statement. So EBIT, and then you divide it by interest. That will give you times interest earned. And for your numerator, if you added back the depreciation, so 741 plus 276, that will be your new numerator. And then you divide it by interest of 141, and that would give you the cash coverage. Third group, asset management ratios. You would need information from both the balance sheet and the income statement. So if you wanted to compute the inventory turnover, that would be COGS, and then you divide it by inventory. Receivables turnover would be sales, and then you divide it by the accounts receivable. For payables turnover, that will be one more time COGS, and then you divide it by accounts payable. Finally, for asset turnover, that will be sales, and then you divide it by total assets. What happened to, there's another typo, sorry about this. There should be two assets. And then finally, for profitability ratios, profit margin will be net income. So all your numerators will be net income. Net income divided by sales would give you the profit margin, and ROA would be net income divided by total assets, and ROE would be net income divided by total equity. So you just have to punch in the right numbers, and your calculator will give you the correct output. Finally, for your market value ratios, let's suppose your stock price was 115 and the number of shares outstanding was 33 in millions. Then your P ratio would be, as saw in the formula section, so you would take the stock price as your numerator, and the denominator of the denominator would be the number of shares outstanding, which is 33. All you would need to replace for each different ratio would be the numerator of the denominator. P ratio will take net income as the numerator of the denominator, and price to sales ratio would take sales as the numerator of the denominator. And finally, for the market to book ratio, you will take total equity as the numerator of the denominator. And everything else will be exactly the same. Once again, your numerator will be 115, which is your stock price. And the denominator of the denominator will be the number of shares outstanding. So you would need to get the per share earnings, per share sales, per share equity value as your denominator. And once again, you will divide your stock prices by that per share book values to get P ratio, PS ratio, and also market to book.